Hello everyone, this week we will learn chapter 13, and in this chapter you will learn about accounting for legal reorganizations and liquidations. We will focus on the bankruptcy laws. We will learn different type of reporting actions that firms can do before they declares bankruptcy. We'll learn the differences between voluntary versus involuntary bankruptcy, different types of creditors based on their status during a bankruptcy, Chapter 7 bankruptcy versus Chapter 11 bankruptcy. We'll also focus on the accounting methods when the firm decides to go for liquidation, and we'll also focus on the accounting part for reorganizations and fresh start accounting. So the basic assumption of accounting is that a business is considered as a going concern entity, but not always we'll find that all companies are proving these going concern assumptions. Sometimes companies may experience financial difficulty, and that could be for a short-term basis or for a long-term basis. So when the companies face this type of financial difficulty, the firm can decide to do reorganizations or liquidations. So when this type of situation occurs, then we have to check who will get all those assets if the firm goes for a liquidation, or if we sell all of the assets at the stage of liquidation, who will get the money. We also need to check whether all the creditors are protected or not. And we also need to check how these type of events will be reported. Now, if you look at these slides, it actually reports very large bankruptcies in last few years, and you will see that all those largest bankruptcies occurred in 2008 and 9 during this economic crisis. We all know about Lehman Brothers or Chrysler's or Citigroup. On the other hand, you can also think of the 2001's economic crisis, where we know all those WorldCom and Enron's bankruptcy events. And we are also familiar with some recent bankruptcy organizations, for example, Toys R Us, Payless Shoes, Radio Shack, or Aerosols. So basically, we will see that sometimes business can undergo occasional financial difficulties, and that could happen because of the economic conditions or intense competitions or poor performance, operating performance, different type of technological changes, but not necessarily all companies will be able to resolve these type of difficulties. That's why sometimes the company may eventually become insolvent. So for insolvency, we actually mean that the company is not able to pay their debt obligations. So now we will focus on the Bankruptcy Act. So for this act, which is known as the Bankruptcy Act of 1978, basically this act provides the legal structure for most bankruptcy proceeding in the United States. And this act has basically two major goals. One is the fair distribution of assets to creditors, and another is the discharge of an honest debtor from debt. So now I'll focus on voluntary versus involuntary bankruptcy. If the company itself files a petition with the court to begin the bankruptcy proceedings, then we will call it as a voluntary bankruptcy. That means for voluntary bankruptcy, the company itself will take the steps. On the other hand, for involuntary bankruptcy, basically the creditors will take the steps, and then the creditor will actually file the petition with the court. Now, here, basically, you will also learn about the involuntary bankruptcy criteria if the firm has several number of creditors, and we will also learn in a minute the classification of creditors, which are fully secured, partially secured, or unsecured creditors. So for a firm with more than 12 unsecured creditors, at least 3 must sign the petition. And the total amount of unsecured debt should be at least $15,325. On the other hand, if the firm has usually less number of creditors, which is less than 12, then only 1 need to sign the petition, and the minimum amount of debt is $15,325. So now here we will see that what happened once the petition is filed. So basically neither a voluntary or involuntary bankruptcy or petition will automatically create the bankruptcy process. The court may reject the voluntary or even involuntary petition because the court may assess the ability of the debtor or the firm whether they can meet the obligations or they really need some other type of help to survive their business. Now, if the court accepts the petition, then it actually grants an order for relief. And then the order for relief actually holds all type of actions against the firm, I mean the debtor or the bankrupt firms. And it also prohibits creditors from collecting debts without the court's permission. And at this stage, actually one trustee is appointed. And the role of the trustee is also very important. Now we will focus on different type of creditors. So first let's know about the fully secured creditors. So these creditors will always have some collateral or backups or liens against the amount of debt, and you will see the value of the assets which is used as a collateral or lien is higher than the amount of the loan. That means their full amount of loan is totally backed up or fully secured. On the other hand, for a partially secured creditor, you will see that the liability or the amount of loan actually is partially covered. That means the asset which is used to cover the loan or used as a collateral, the value is actually lower than the total amount of loan. On the other hand, all other type of liabilities are considered as unsecured, and in this case creditors have no legal right to any of the assets, debtors or the company's assets. They are entitled to share only if any funds that remain after all secured claims have been settled up. Now here we will also learn about a bit about the priority of the unsecured group of creditors. So for unsecured group of creditors, they basically don't have any right on any assets of the debtor or the bankrupt firms, but when all other type of creditors are paid, that means the secured and fully secured, then if any remain free cash or assets are there, then we can pay this unsecured group of creditors. Again, we have to check the priority order. For example, first you have to pay if there is any cost related to the liquidation of process. And if you see that any type of new debt arises between the bankruptcy filing date and the issuance of an order of relief. And also sometimes you may see that the employees, they can also claim wages. That means they worked for the company but they didn't get the wage, and that happened during the 180 days preceding the filing of a petition. Then definitely we need to pay, but there is a limit. So the limit is that $12,850 per employees, and that is actually the latest regulation as per the act that is actually amended in 2016. Now, customer deposits. Sometimes customer may pay in advance, but the company may not be able to ship their goods or provide any type of services. So in this type of situation, of course, you need to pay the customers back. Again, there is one limit. This is $2,850 per customer. And of course, you have to pay your unpaid taxes. Now here we will learn about the difference between chapter 7 and chapter 11, and that is basically liquidation versus reorganization. So you may hear these two terms frequently, but what is the main difference? So for this chapter 7, these guidelines, these legal guidelines is actually for liquidation. That means when the company decides they will not continue the business anymore, they will exit, they will liquidate the company. That means they're gonna start selling all of the assets and pay back to the creditors based on their priority. And this is called the liquidation process, and these legal guidelines are discussed under chapter 7. On the other hand, chapter 11 focused on the reorganization process of the financially difficult company. That means in this type of situation, companies, they try to do their best to reorganize the company, reshuffle, reclassify all those creditors or the loan amounts, and they try to continue the business. So chapter 11 basically focused on the reorganization part. And both these chapters are from the Bankruptcy Act, 1978 Bankruptcy Act. So when we will go for either for reorganization or liquidation, of course we need to make sure we do all of our proper financial statements. So here we will focus on the statement of financial affairs, which is really very important. So at the start of bankruptcy proceedings, the company basically prepares a statement of financial affairs. This is some sort of a schedule that provides the vital information about the company's financial positions and also helps guide all parties as they consider what actions to take. The statement is especially important in assisting unsecured creditors, right? Because unsecured creditors are really uncertain whether they will get any amount back if the company is liquidated. That's why you will see that sometimes unsecured creditors may push for reorganization, or if they see that they will not be able to get back any money. So here the company will of course report all of their assets and liabilities, and that will be reported according to the classifications that are relevant to a liquidations. So here I just focused on exhibit 13.1 and 13.2, and you will see, I'll take you in a minute to the textbook chapter, and that is actually page number 625, and you will take a quick look and you will see how the assets are leveled and how the debts are leveled, and of course those are based on the priority. For examples, you will see that the assets, those are actually reported, I'm talking about the statement of financial affairs, those are actually reported based on this placed, whether these assets are used for fully secured creditors or partially secured creditors, and then they will report all free assets. On the other hand, for the liability side, we will report first the liabilities with priority, and then we will of course show fully secured creditors, then partially secured creditors, and then unsecured creditors. Now I'm showing you my electronic textbook, and I want to focus on the statement of financial affairs, how it looks like. So this is from your textbook, page number 625, and if you look at this exhibit 13.1, this is the company's balance sheet, and the typical balance sheet that we usually do, assets and liabilities, and of course the company is struggling. You can see their retained earning deficits, and the company wants to go for this bankruptcy. And what happened here, they actually prepared this statement of financial affairs. As what I just mentioned, you will have the asset side, and at the same time you will have the liability side. So basically you are kind of representing your balance sheet, but you are reclassifying it. So for the asset side, you have to show all of your assets, but you have to show first the assets that you are using to secure your creditors. So these are the assets that are used to secure fully secured creditors. For example, land, building. This is the value of their land and building. If you go back to their original balance sheet, you will see that these are the values, but these land and building are used to secure notes payable. So that means if you subtract all of your obligations and the secured amount of credits or the loans or notes payable, then you will see that basically the free amount of from this land and building asset is $26,000. Again, now you can look at the inventory. Inventory is used to support or secure your notes payable, and this inventory used as a collateral. But if you see the notes payable value is actually higher than the inventory value. So that is why actually we will say that the notes payable, this part is partially secured, and when all of this inventory will be used up to cover these notes payable, basically you will get nothing from these assets. So that means these are not free assets, these are used as collateral. So when we are going to prepare the statement of financial affairs, we will show those assets, those are actually used as collateral, or the assets actually are backing up the securities, and then later you will show your free assets. So these free assets, those are not used to back up any type of credit amounts. So now the column will actually mention all of your available assets. On the other hand, when you're gonna prepare your liabilities and stockholders equity portion, so basically we'll focus on the liabilities, will give the priority. For example, these liabilities, these are usually, you will see these are unsecured, but these will get priority. What I just mentioned, any administrative expenses related to the liquidation process, salaries payable or tax, but you have certain limit, those are unsecured although, but you have to pay them first, and then you have to pay your fully secured creditors, then partially secured creditors, and we know we are using those assets, and then we will see that what are the remaining unsecured portions of liability. So we are here reclassifying our balance sheet, but based on the priority of our creditors, and on the other hand, the situations of, or the freeness of our assets. Now let's go back to our slides. So this is actually, we just explained exhibit 13.1 and 13.2. Now here next we will focus on our bankruptcy process, and let's learn about the chapter 7 bankruptcy, where the company will go for the liquidation. So basically here what I mentioned, that a trustee will be appointed by the court, and this trustee actually plays a significant role. This individual must recover all property and belongings to the insolvent company, and the trustee will preserve the state from any deterioration or liquidate any non-cash assets, and he will make sure that the proper distributions to different type of creditors are ensured. So now here again you will have a committee that will also help the trustee, and here this slide also discussed about the trustee's roles. So definitely the trustee will record all activities and report them periodically to the court, and of course to the other interested parties. And basically here a wide variety of statements has been utilized to report these ongoing liquidations, and the trustee will also prepare a statement of realization and liquidation, and that's a quick method to report the impact of events as they occur during the liquidation process. So here we will also focus on this statement of realization and liquidations. And of course, I mentioned earlier the trustee will keep record or keep track on the assets of the companies, and the statement of realization that the trustee will prepare, it is prepared to convey very important information to the interested parties. So it of course will report the account balances and any type of cash receipts if they start selling the property, and the cash disbursements, and of course any other transactions, such as if you need to write off any assets, and the recognition of unrecorded liabilities. Now we'll focus on the accounting part of liquidation. In 2013, FASB issued Accounting Standards Update, which is known as 2013-07 Liquidation Basis of Accounting. And official reporting standards prior to these pronouncements had been virtually non-existent for companies in the process of being liquidated. And basically here, when this act is taken by FASB, it focuses on 4 essential questions about the reporting of a company and the company which is going to be liquidated. So basically the questions are, when is a company viewed as actually being in liquidation so that the liquidation basis of accounting becomes necessary? At a minimum, what statements should be reported during liquidation to be in conformity with US GAAP? And how should the liquidating company's assets be reported during this period? And how should the liquidating company's liabilities be reported during this period? Now, we will focus on the financial reporting for the liquidating entity. And basically here, those reporting, it must include a statement of changes in net assets in liquidation to investors and other claimants. And of course, we will also see an income statement or statement of comprehensive incomes, and company will also issue a statement of net assets in liquidation, and the reason is to allow all interested parties to gain information about the net assets available for distribution. On the statement of net assets, the company will report all of their assets, and basically that's an estimated amount and the amount that they will be able to collect when they will sell the asset or liquidate the assets. And of course, they need to report all the assets that can be used to generate cash during the liquidation process. Now, on the liability sides, liabilities remain reported at the amounts due until they are settled. And basically, you will see that these equity amounts are not reported because that information is not relevant to the liquidation process. Now we will focus on Chapter 11 Bankruptcy. So Chapter 11 Bankruptcy means reorganizations, and this is basically Chapter 11 actually allows the parties a chance to salvage the business so that the company can continue their operations, and it basically can protect the creditors, and creditors are encouraged to negotiate with the company. So in this stage, the control will be kind of maintained by the control of the company is normally maintained by the owners, but that can be taken over by the creditors. But as the company will continue their business, workers can keep their jobs, suppliers can keep their customers, and customers maintain their source of supply. So now here under Chapter 11 Bankruptcy, the company needs to do a reorganization plan, and the reorganization plan actually contains different types of provisions that can help company to recover the financial difficulty. And here the plans could include some sort of planning that can propose the change in the company's operation, or the plan could help to generate additional monetary resources. That means sometimes the government can bail out, or they can take loan for a short-term period, or they can take loans and they can sell some common stock or preferred stocks. So the plan can involve for changing in company's management. Maybe they can hire more skilled top executives, or they can plan to settle the debts that existed when the order for relief was entered. So now here, once different type of plans and provisions are developed, so you need to accept the plan, and to accept it, 2/3 of the dollar amounts or more than 1/2 of the creditors must need to vote, and of course 2/3 of each class of stakeholders should approve it. And once the plan is approved, the court will confirm the acceptance. And but sometimes the court can overrule, sometimes the court can also force the acceptance of a plan that was not voted by the stockholders or the creditors. And even there might be different type of plans approved by the company or creditors or shareholders, but the court can also take any decision and convert it from chapter 11 to chapter 7. That means the court may think that reorganization is not possible, and they can ask to go for liquidation. Now here, this reorganization process also arise some specific questions. So once the reorganization process is done and accepted by the court, but the companies need to face different significant accounting question. Should the income resulting from the continuing operating activities be differentiated from transactions connected with this reorganization process? If so, how are those reorganization items identified? Or if there is any liability reported, how we should report that? Some debts might not be paid for years and then require payment of an amount considerably less than face value. So how the companies should present this information? Also, we need to think of that whether this reorganization necessitates a change in the reporting basis of company's assets. Is the previous carrying value still relevant? So FASB's topic 852, and that is related to reorganizations, and that requires financial statements be prepared during the reorganizations and when the entity emerges from reorganizations. Now here we will see some examples. Now we will see how the financial reporting will be during the period of reorganization. So basically we'll prepare one income statement during reorganization, and of course the balance sheet. So the income statement will show you all gain, losses, and any type of revenues, expense that are related to the reorganizations. So I basically will take you to the textbook so that you can see the examples. This example is from page number 637, and that's exhibit 13.6, and the example of Crawford Corporations, and this is the income statement during the reorganization. So if you see that up to this, it's regular income statement. You have revenues, cost of goods sold, all other expenses, and then you will report the earnings before reorganizations items and tax effect, and then you will include all of your reorganization related expenses, fees, and of course you will show you will have a loss because you are bearing all these expenses, legal fees related to reorganization, and you will also do the tax adjustments. And here I will also show you how the balance sheet will look like. Well, basically the textbook didn't say about the balance sheet, but here the example shows through one trial balance. So basically here, if you want to take a look at the example, basically you will see this is the items, their liabilities and all of those items before the reorganizations. So they actually prepared one trial balance. Here this is the trial balance. They listed all of their items from the balance sheet, and this is just before their reorganization process. And then they have other information related to those assets and how they dealt with all these liabilities, legal obligations, and later how you can do the fresh start accounting. So if you look at these trial balance prior to that bankruptcy, of course you will see retained earning is actually negative. That means a deficit amount. That's why it is shown as a debit item. But retained earning is usually a credit item, but since it's a negative item, that means the company is struggling. That's why they have this negative or debit side or debit balance. Now you will see they have these assets, and at the same time they have these liabilities. Of course the company faced these financial struggles, and they fail to meet up all these obligations, different type of liabilities, and that's why they go for this reorganization. So definitely what they will do, first, to deal with the assets, they will check what's the fair value of those assets. So if you go back, you will see they have the assets, land, building, equipment. These are the physical assets, and these are the book value. And they found that the fair value of those assets are higher. So when they're gonna do the fresh start accounting, they will do the adjustments with these differences. For example, the land, if you have your textbook, the land has a value of $100,000 book value, but the fair value is $120,000. So they will do the adjustments, $20,000 to increase the land value. And if you go here, your building's book value is $400,000. So they will check what's the fair value. It's $500,000. So they will do the adjustments to increase the building value. They have one asset, trademark, that is not on their book, but they will recognize it or report it after the reorganization. And then when they want to value the company after reorganizations, they found that the value is in between 900,000 to 1.3 million. So they basically will assess one value, and they decided that the value of the company, that means total assets, will be $1 million. And we'll see how they will do the journal entries to do all these adjustments, how they will recover this negative retained earnings, and we will basically use the additional paid in capital account to do all these adjustments. Now let's look at the liability side. So if you see their liability side, they have accounts payable, they have accrued expenses. We know these are short-term obligations. They are supposed to pay these very immediately. They have some long-term liabilities, notes payable, which is due in 3 years, bonds payable due in 5 years. And of course, the company was not able to pay these obligations. So they will try to take some steps so that they can negotiate with the debt holders. So let's see what they did. So basically here, if you see that the company has accounts payable, another accounts payable, and that actually incurred after the order of relief was granted. And of course, they must have to pay all this. Now, you will see what are their other liabilities. So what I mentioned here, they have 4 other liabilities. Accounts payable, 60,000, accrued expenses, 50,000, notes payable, 300,000, bonds payable, 600,000. That means the total amount of liability is $1,010,000. And then what they did, they actually combined the accounts payable and accrued expenses, and they actually converted it into 1-year notes with a face value of $70,000. And of course they will pay interest because they are not able to pay them, so they need 1 more year, and they negotiated with all those creditors and they're gonna pay it, and basically after 1 year they will pay the interest. Now here they have $300,000 notes payable, which is due in 3 years. this notes payable is due in 3 years, but the company is not able to pay, and they are not sure whether they will be able to pay in 3 years. So what they did, they actually converted these 3 years $300,000 notes payable into a 10-year $100,000 notes payable. That means they are getting another extended period, and they will pay it in 10 years. And if you look at the amount, it was 300,000, but they will pay 100,000. But that's not it. They will pay $20,000 stocks, common stocks, to those note holders. And of course, we'll check the numbers, what's the value, par value of the common stocks, and whether if even after paying the common stocks and the note amount, they decided $100,000, if they are making any gain on debt discharge. They will also negotiate with the other liability items, which is bonds payable, and they think that they will not be able to pay in 5 years, and the amount was $600,000. So what they negotiated with the bondholders. So this with bondholders, they converted into 8 years, 9% interest notes, and they decided the value is for $30,000. So again here, these bonds are supposed to pay back in 5 years, but they are now getting extended period, and of course they will decide how much interest they will pay, and they decided the amount is for $30,000. And of course, to satisfy the bondholders, they will give some stocks. They will give 15,000 shares. Now we'll again check, they are renegotiating with the bondholders. The amount of debt is $600,000. They are getting extended period to pay that back, and they renegotiated the amount. New value of their notes will be $430. They are also giving some stocks. We'll do the adjustments. We'll do the journal entry, and we'll see whether they are making any gain on these debt negotiations or debt discharge. Now we'll see the stockholders' equity. Remember, the owners will give $35,000 because they need to satisfy these bondholders and note holders. So we'll do the adjustments, and all these adjustments, what we are going to do now, will be against their additional paid in capital. And remember, they have a negative or deficit retained earnings. So our goal is to make this retained earning amount 0, because we are doing a fresh start, as if the accounting books are starting now just as a new business. So we will make this negative amount or deficit retained earning or debit retained earning as 0, and we will use additional paid in capital to do all the adjustments, and we'll also need to close if they make any gain on debt adjustments or debt resettlement or discharge. Now let's see the journal entries that you need to do when you will do the fresh start accounting. So what I mentioned here, if you see that there is a difference between the book value and the fair value of the assets, then you need to do the adjustments. So once when I discussed this asset item, I mentioned that the company decided the value of these assets will be $1 million based on the company valuation. So now we found that the assets, few of the assets are actually lower as per the book. So we'll do the adjustments to report their fair value, and we'll show the total asset difference is total asset value is $1 million, and if we have any difference, we will show it as a goodwill. And of course, we'll also mention trademark. Now look at the asset part. Can you check what's there? What's the total amount of assets? So if you check here, they have all these assets: cash, land, building, equipment, 50,000, or if you add all these 100,000, 400,000 plus 250. So add all these, you will find that the total amount of asset before the reorganization is 800,000. But now when the company will be reorganized, we want to show the asset value as 1 million. That means we need to increase the asset value by 200,000. So how are we gonna increase it? Definitely we will increase the land building, we'll show trademark, and if we have any difference we will report as a goodwill. So this is the journal entry you will do to adjust the asset value. So we will record trademark, which was not on their book previously. We need to increase land by 20,000 to reflect the fair value. We will increase the building 100,000, but remember we want to increase the total value of the assets by 200,000 because our goal is to show the asset is 1 million, which is decided during the reorganization period, and the reported value of assets before this process was 800,000. So total we will increase our assets by 200,000. And this is the special treatment. We will use the account additional paid in capital to show this asset adjustment. Basically, we're gonna use this additional paid in capital for all adjustments that the company will do during the reorganization period. Now, the owners will give these 35,000 shares, what we discussed earlier, because you need to give those shares to satisfy or to renegotiate your debt holders, bond holders, and note holders. So that's why what we're gonna do, we will close our common stock amount. So remember, common stock is usually a credit item. Now we are removing this common stock, 35,000 shares, and their PAR par value is $1. That means the common stock amount was 35,000 multiplied PAR par value $1. We want to remove it, so we debited this common stock. And again, all journal entries, all adjustments will be using the additional paid in capital. So we are using additional paid in capital against it. Now we will show how we renegotiated the liabilities. We have accounts payable and accrued expenses. So if you go back to our trial balance prior to the renegotiation, the amount was 60,000 and 50,000. So what we did, we actually renegotiated it. So we have to remove these old liabilities, accounts payable and accrued expenses. So we're gonna debit those. And at the same time, what we did, we actually signed 1-year note, and the value is $70,000. So we'll do the adjustments. Next journal entry is showing the adjustments. So we removed our old short-term obligations, accounts payable 60,000, accrued expenses 50,000, and we issued a new notes payable 1 year 70,000. But remember, both these two together is 110,000. So after doing this renegotiation, you are making a gain, and this we will record as a gain on debt discharge. This is a temporary account. We are just showing to reflect all the changes that happened in our liability sides, but remember we have to close this gain on debt discharge at the end of the renegotiation process. Now we will do the same thing with the other liabilities. So we had notes payable. This is the old notes payable. So if you go back to the trial balance, I'm not going back and forth, but you should have your textbook. Notes payable, which was due in 3 years, and that had a $300,000 amount. So we will close the old notes payable, and we will record the new notes payable, and we decided the value is $100,000. And we also gave this group of creditors 20,000 shares. So here we will record that 20,000 shares as per our PAR par value, and we will see that what is the gain on these notes payable. Remember, you are recording these notes payable renegotiation. The total value was 300,000. You created new notes payable 100,000. When you issued these common stocks, that means you are giving 20,000 common stocks, and when you are doing the additional paid in capital and common stock, the total value is 100,000 plus 20,000. That means 220. That means you are removing $300,000 debt, adjusting up to 220. So the remaining amount we will call gain on debt discharge, and it's a gain since we renegotiated our obligations. So we will actually credit that. Now you may ask the question, how do we determine the additional paid in capital value as $100,000? So to get the answer, I need to go back. So when we decided all this information that we will do during the reorganization, remember here we decided the asset side total asset value will be 1 million. That means if you try to imagine their balance sheet, the liabilities and stockholders equity, the other side of the balance sheet will also be 1 million. Now look at the liability side. During the reorganization period, they have new liabilities, accounts payable, and then they renegotiated their old liabilities, and after doing this, their basically total liabilities will be 700,000. Why? Because they basically created these new liabilities, $100,000, for their renegotiation process. They converted their accounts payable and accrued expenses into 1-year note and determined the value as $70,000. They renegotiated their notes payable and bonds payable. They gave some stocks. We already discussed that, and these are the new values of those two long-term assets, notes payable and bonds payable. That means once they will go through the renegotiation steps, they want to show their total assets as 1 million and total liabilities and stockholders equity also 1 million. Now you see the total liability is 700,000, so your stockholders equity should be 300,000. Right. Now if you look at their common stocks, their common stock is $50,000 and they have 50,000 shares. Although they actually gave 35,000 shares to the bondholders, still the number of outstanding shares are the same, 50,000 shares, right? And at the same time, if it's $1 par value, the common stock value should be $50,000. Although the ownership changed, the shares were owned, these 35,000 shares were owned by the owner of the company. Now those are owned by those new people, their notes holder and bonds holder. But basically the number of outstanding shares are still same, 50,000, and according to the par value, par value, their common stock will remain the same, $50,000. And we just discussed that their other side of their balance sheet will show that their liabilities and stockholders equity total will be $1 million, as we decided the total assets will be 1 million, and we just show the debt amount, all those liabilities. Debt amount is 700,000, so the 300,000 will be stockholders equity, where 50,000 will be the common stock. So the remaining amount we will show it as the additional paid in capital. So their adjusted additional paid in capital at the end of the reorganization process will be 250,000 shares. Now if I go back to this journal entry where we showed we renegotiated with these notes holders and we actually issued 20,000 shares. Remember the total number of shares is 50,000 and we gave 50. Now out of this 50,000, 35,000, we actually gave 20,000 to this group, these creditors. That means these 20,000 shares out of 50,000 means 40% of the shares. So we will do the adjustment. We will consider according to our total additional paid in capital value, which is we just showed you should be 250,000 after all adjustments. So since this 20,000 shares means 40%, So we will also report here the 40% additional paid in capital, which is 100,000, 40% of our determined $250,000 additional paid in capital. So now we will do the same thing with the other group of creditors, bonds holder. So we know we had this bonds payable previously, which was due in 5 years, and the amount was 600,000, but we renegotiated it. We need to close this old bonds payable, remove this old bonds payable, issue new notes payable 8 years, and the amount is 430,000. And again we issued shares, which is $15,000, $1 PAR par value. So we credited common stocks, and then at the same time these 15,000 shares, out of all shares outstanding, 50,000 is 30%. Our determined additional paid in capital is 250,000. So for this debt renegotiation, we will credit the additional paid in capital as 75,000, so it is 30% of 250,000. Now, if you check the journal entry, we are getting of $600,000 bond payable. We issued 430 notes payable. If you consider common stock and additional paid in capital, which we transferred from the owners to the bonds holders, and we still make a gain. Right, so we will credit the gain on debt discharge, the remaining amount that will also balance your journal entry. We call it gain on debt discharge, which is from these bonds payable adjustments is $80,000. Now we will do the last journal entry, and that is to remove these gain on debt discharge, because this is a temporary account to do the debt renegotiations. We of course need to remove our retained earnings, which was a negative or deficit balance. We'll make a fresh zero retained earnings, and again everything will be adjusted here against the additional paid in capital. So if you go back, before this bankruptcy or reorganization process, our retained earning was $400,000. That's a deficit, right? So that means that's a debit amount. We need to remove it. We need to make it a zero. So we will credit $400,000 retained earnings. Now, if you check gain on debt discharge, you have 3 types of debts. I mean, these short-term accounts payable and accrued expenses. When you got rid of this, you had a gain on debt discharge 40,000. Then for this notes payable thing, you have a gain 80,000, and you have another gain here for bonds payable 80,000. So your total gain on debt discharge is 40 plus 80 plus 80. That means 200,000. So we're gonna close it. And if you look at this journal entry, you will see that to remove this negative retained earnings, we are renegotiating with our creditors, bondholders, they are notes payable or note holders, and we are making a gain. We of course transferred some common stocks, and we still need to do these adjustments. The balance will show as additional paid in capital. Now if you check all these balances, we actually determined what will be the additional paid in capital, but now you can do little t accounts. The additional paid in capital balance, basically it was $40,000. Then we did the adjustments, first adjustments, asset price, asset values, we adjusted to fair value. We credited additional paid in capital 200,000. Then for closing common stocks, we credited 35,000. Then when we did this notes payable and bonds payable negotiations, we gave these new shares to 20,000 and 15,000. So the owners gave the shares to the bondholders and notes holders. We also calculated what amount we should record as additional paid in capital. Now if you adjust all these credit items and the final amount here, what we had to debit to balance this entry, your additional paid in capital balance will be 250, which we also discussed because in one side your total asset after this reorganization should be 1 million. That's what we did. We created this goodwill, we adjusted all assets up to their fair value, we listed this trademark, we renegotiated all these credit sides or liability sides, and then here we actually, our common stock outstanding will be the same. We did all adjustments against the additional paid in capital, and we removed this retained earning deficit, which was the main goal of this renegotiation, and we did a fresh start accounting. So this process seems a bit clumsy, but I would suggest you please read the last few pages of your textbook, and of course we will do some practice problems, and I'll post you the solution and the video of these problems too. Thank you for keeping your patience.